Hi everyone, welcome to Charts and Perspective, where we use charts to dive into the world of economics. I'm Jennifer Nash, an economic and market research analyst for Verify. Today we're assessing the market's overall valuation using 4 key indicators that I update monthly with data through January 2025. The 4 market valuation methods are the Cressmont PE ratio, the PE10 ratio, the Q ratio, and the relationship of the S&P 500 to a regression trend line. Market valuation indicators help gauge whether the market is over, under, or fairly valued compared to historical norms. Relying on just one can be misleading, so by analyzing multiple, we get a broader perspective. Now, to simplify comparisons, I've adjusted the 2 PE ratios and the Q ratio to their means and the inflation-adjusted S&P composite to its exponential regression. You'll notice the S&P regression data is shown as a light blue shaded area rather than a line chart like the other 3, and this just helps improve readability and distinguishes the regression series from the other 3 simple ratios. On the vertical axis, percentages indicate how much each metric deviates from its mean. Since periods of over and undervaluation can last years, these indicators are not useful as short-term market timing tools. Now, on the title slide, I asked, is the market still overvalued? From this chart, the answer is yes, but how overvalued is it? In the upper left, a table shows each method's distance from its arithmetic mean as of January. The Cressmont PE is 164% above, PE10, 112% above, Q ratio, 121% above, and the inflation-adjusted S&P composite, 179% above its regression trend line. That puts the market's overvaluation between 112 and 179%, just depending on the indicator, one of the highest levels in history. Now let's take the average of these 4 indicators and plot it, along with the standard deviations above and below its mean. At the end of January, the average stands at 144%, 3 standard deviations above its historical mean. In other words, the market remains significantly overvalued, trailing only November and December of last year. Now I want to provide an alternative view. I've adjusted the Cressmont PE, PE10, and Q ratio to their geometric means rather than their arithmetic means, which is the average that most people think of. And we use that in the first 2 charts. Now with this approach, the overvaluation range shifts slightly higher between 133% and 192%. Again, plotting the average with standard deviations, we see the latest figure at 163%, 3 standard deviations above its historical mean. The conclusion remains the same. Valuations are among the highest on record. So let's go back to our initial question. Is the market still overvalued? Yes. In fact, we're currently at some of the highest valuations in history. And to wrap up, I just want to reiterate that these indicators are not short-term market timing tools. Overvaluation and undervaluation can last for years. Instead, they're more appropriate for formulating expectations for long-term market performance. And that's our January 2025 market valuation update. Thank you for tuning in. For more economic and market insights, check out my work on advisor perspectives under the AP Chart section.